If you were born before 1963, there is real, verified news about Social Security you need to hear. Not the vague, alarming kind of headline that tells you to move your money without ever explaining why, but the actual, documented changes that took effect this year, and the ones on the horizon that could genuinely affect how much you receive and when you should claim. And unlike a lot of what circulates online, everything in this video comes from official sources, including the Social Security Administration itself, the 2026 Trustees Report, and nonpartisan analysts who track this program closely. So if you want a clear, honest picture of where Social Security actually stands right now, stay with us, because understanding these changes could meaningfully affect your retirement planning. Let's start with the most fundamental shift, one that has been unfolding gradually for more than 4 decades and finally reached its conclusion this year. Back in 1983, Congress passed a set of reforms designed to keep Social Security financially sound for the long term. And one of those reforms was a gradual increase in what is called full retirement age, the age at which a person becomes eligible to receive 100% of the retirement benefit calculated from their lifetime earnings. For decades, full retirement age was simply 65, but the 1983 law began pushing that age upward, 2 months at a time, based on a person's birth year. According to Kiplinger and multiple retirement planning outlets, that phase in process officially finished in 2026. If you were born in 1959, your full retirement age landed at 66 years and 10 months. If you were born in 1960 or later, your full retirement age is now a flat 67, with no further scheduled increases under current law. For anyone born before 1963, this matters because it defines the benchmark against which your own benefit reductions or increases are measured, whether you already claimed benefits years ago or are still deciding when to file. It's worth pausing here to clarify something that causes a lot of confusion, because full retirement age is not the same as the earliest age you can claim benefits. You can still begin collecting Social Security retirement benefits as early as age 62. That has not changed, but claiming before your full retirement age results in a permanent reduction to your monthly check. According to reporting from the Hill and figures published by the Social Security Administration, someone with a full retirement age of 67 who claims at 62 could see a benefit reduction of around 30%. And if you are receiving a spousal benefit rather than your own, that reduction can be even steeper, up to 35%. On the other end of the spectrum, if you delay claiming beyond your full retirement age, your benefit continues to grow by roughly 8% for each year you wait, up until age 70, at which point there is no further advantage to delaying. According to figures from NARFE, the National Active and Retired Federal Employees Association, the maximum monthly benefit at full retirement age in 2026 is $4,152, while someone claiming at 62 would see a maximum of $2,969, and someone waiting until 70 could receive as much as $5,181. These are maximum figures based on a lifetime of high earnings, so your own numbers will likely be lower. But the pattern holds true across every income level. Timing your claim has a real, lasting impact on your monthly income. Now let's talk about the increase that most current beneficiaries actually notice first, the annual cost of living adjustment, often referred to as the COLA. Every year, Social Security benefits are adjusted based on changes in the Consumer Price Index for urban wage earners and clerical workers, a measure of inflation tracked by the federal government. For 2026, according to NARFE and multiple retirement planning sources, benefits increased by 2.8%, slightly higher than the 2.5% increase applied in 2025. According to CNBC's reporting on the Social Security Administration's own announcement, the average monthly retirement benefit for 2026 was projected to be around $2,071 following that adjustment. For many retirees, this translates to roughly an extra $50 to $60 per month, which may not sound dramatic, but compounds meaningfully over the course of a year and helps offset, at least partially, the rising cost of everyday expenses like groceries, utilities, and healthcare. Speaking of healthcare, it's important to mention Medicare Part B premiums in this same conversation. Because for most retirees, these premiums are deducted directly from Social Security checks, meaning the two programs are financially linked in a very real, practical way. According to figures reported by RetireHub, the standard Medicare Part B premium for 2026 sits at $202.90 per month, which works out to roughly $2,435 over the course of a year. While that premium increase is separate from the COLA calculation, it directly affects how much of your cost of living increase actually reaches your bank account each month, since higher Medicare premiums can offset a meaningful portion of your Social Security raise. This is a detail that often gets lost in broader retirement planning conversations, but it is one of the most concrete, checkbook-level realities that affects nearly every Social Security recipient once they reach Medicare eligibility age. Now let's move to a topic that has generated a great deal of attention in 2026, and rightly so, because it involves official government projections rather than speculation: the long-term financial health of the Social Security trust funds. Every year, the Social Security Board of Trustees releases a detailed report projecting how long the program's trust funds can continue paying full scheduled benefits under current law. According to the official Social Security Administration press release announcing the 2026 Trustees Report, released on June 9th of this year, the Old Age and Survivors Insurance Trust Fund, the fund specifically responsible for retirement benefits, is now projected to become depleted in the fourth quarter of 2032. That is 1 quarter earlier than the projection in the 2025 report, which had estimated depletion in early 2033. According to the Congressional Budget Office, an independent, nonpartisan agency that conducts its own separate analysis, their February 2026 projection arrived at a similar depletion date, also landing in 2032, though their estimate of the resulting benefit reduction differs somewhat from the trustees' own figures. It's essential to explain clearly what depletion of the trust fund actually means, because this is frequently misunderstood, and misunderstanding it can lead to unnecessary panic. Depletion of the trust fund does not mean Social Security disappears or stops paying benefits entirely. Social Security is funded primarily through payroll taxes collected from current workers, and that ongoing revenue stream continues regardless of what happens to the trust fund's reserves. According to the official Social Security Administration statement, if the Old Age and Survivors Insurance Trust Fund reserves are depleted as projected, incoming payroll tax revenue would still be sufficient to pay approximately 78% of scheduled benefits. Other analyses, including one from the Committee for a Responsible Federal Budget, a nonpartisan fiscal policy research organization, estimate the resulting cut at closer to 22 to 24%, which would translate to an average reduction of around $500 per month for affected retirees, according to their published research. These figures vary slightly depending on the source and methodology, which is worth noting for full transparency. But the underlying conclusion across every credible source is consistent. Without congressional action, benefit reductions of a significant magnitude are projected to begin around 2032, a date that falls within the working or early retirement years of many people currently in their 50s and 60s, including a substantial share of people born before 1963. Several factors have contributed to this accelerated timeline compared to earlier projections. According to analysis from the Committee for a Responsible Federal Budget, changing demographic assumptions play a significant role, including lower fertility rates and reduced immigration, both of which affect the number of workers paying into the system relative to the number of beneficiaries drawing from it. Additionally, recent tax legislation has affected the program's revenue projections. According to CNBC's reporting, Social Security's chief actuary noted in an official letter that changes to the taxation of Social Security benefits under recent tax law would have what was described as material effects on the trust fund's financial status. It's worth being clear and precise here, because this is a technical, evolving area of federal policy. This is not a claim that any single piece of legislation single-handedly caused the projected shortfall, but rather that it is one of several contributing factors identified by the program's own actuarial office, alongside broader demographic and economic trends that have been building for years. Given all of this, it's reasonable to ask whether this kind of shortfall has happened before, and the answer, according to multiple sources including CNBC and AARP, is yes. In 1983, Social Security came dangerously close to being unable to pay full benefits, and Congress responded with the same 1983 reform package we discussed earlier, one that increased payroll taxes and gradually raised the full retirement age, exactly the change that finished phasing in this year. That set of reforms extended the program's solvency for more than 4 decades. Whether Congress will act again before 2032, and what form any future reform might take, remains genuinely uncertain, and responsible reporting requires acknowledging that uncertainty rather than predicting a specific outcome. Multiple experts quoted in recent coverage, including policy analysts at the Bipartisan Policy Center, have expressed concern that despite this problem being publicly known for decades, meaningful congressional action has yet to materialize, though this remains a matter of ongoing political debate rather than settled fact. And viewers should understand that projections, even official ones, are estimates based on current assumptions, not guarantees of what will actually happen. It is also worth noting that independent analyses do not always agree precisely. For example, a separate forecast from the Penn-Wharton budget model at the University of Pennsylvania places the projected depletion date slightly later than the official trustees' report, illustrating that reasonable, credible experts using different models can arrive at somewhat different conclusions, even while agreeing on the broader trajectory. So what does all of this mean, practically, for someone born before 1963? First, it means your full retirement age is already fixed under current law, either 66 and 10 months if you were born in 1959, or an earlier age still if you were born even earlier. So at this point, that particular number will not change for you regardless of future legislation affecting younger generations. Second, it means the cost of living adjustment for 2026 has already been applied to your benefit if you are currently receiving one, providing a modest but real increase to help offset inflation. Third, and most importantly for long-term planning, it means the conversation about trust fund depletion around 2032 is directly relevant to your own retirement horizon, not a distant, abstract concern reserved for younger workers, since many people born before 1963 will still be receiving benefits well beyond that date. This is precisely why understanding your own claiming strategy, whether you have already claimed, are currently receiving benefits, or are still deciding when to file, matters more than ever, and why consulting directly with a licensed financial advisor or using official Social Security Administration resources to model your specific situation is genuinely worthwhile, rather than relying on generic online calculators or unverified claims about supposed loopholes or secrets. It is worth addressing directly, given how much confusing and often misleading content circulates online regarding Social Security, that there is no special program, secret loophole, or official directive requiring anyone born before any particular year to move their money out of Social Security or into any specific investment product. Social Security benefits are paid directly by the federal government according to the rules we have just described, based on your earnings history, your birth year, and your claiming age, and any content suggesting an urgent, unexplained need to relocate your funds in response to a vague warning should be treated with significant skepticism. The genuinely important, verified information is exactly what we have covered in this video: the finalized full retirement age, the 2026 cost of living adjustment, updated earnings limits for those still working while claiming benefits, and the trustees' updated projections regarding the trust fund. For the most accurate, personalized information about your own benefits, the official Social Security Administration website, along with your own personal Social Security statement. which you can access through a free online account, remain the most reliable sources available and are always worth checking directly rather than relying solely on second-hand summaries, including this one. To bring this all together, 2026 has been a genuinely significant year for Social Security, not because of any hidden directive or mysterious instruction to move your money, but because of several concrete, verifiable developments. The completion of the decades-long increase in full retirement age to a flat 67 for anyone born in 1960 or later, a 2.8% cost of living adjustment that modestly increased monthly checks, updated earnings limits for beneficiaries who continue working, and an accelerated projection for the depletion of the retirement trust fund, now expected in late 2032 according to the official trustees' report, a full year earlier than previously projected. These changes carry real implications for anyone born before 1963, particularly those still deciding when to claim benefits or planning their broader retirement income strategy around what Social Security will realistically provide in the years ahead. As always with financial and legislative matters, this situation may continue to evolve, particularly if Congress takes up reform proposals in response to these updated projections, and we will continue to bring you accurate, verified updates as that story develops. If you found this breakdown helpful, please consider liking this video, subscribing to the channel for more accurate, well-researched coverage of Social Security and retirement planning, and sharing your own questions or experiences in the comments below. We read them, and they often shape the topics we cover next. Thank you so much for watching, and we will see you in the next video.